Well, Sabrina, it's such a pleasure to have you here. Thank you for joining us.
Yes, thank you for having me. Excited to be here.
So Sabrina, we want to start with just you introducing yourself. What is your role at LSEG and what's been your path until this point?
Yeah, so I head up Global Investment and Wealth Solutions for LSEG. And my path has been an interesting one because it's not your typical path to lead a global technology, wealth, and investment solutions company. I started on the investment consulting side, where I worked with the largest plan sponsors across the US. I spent almost 2 decades in that field before moving to global asset management. So I was actually on the client side for a number of years, and then moved from asset management into the digital space at the asset manager, at which point in time I realized data and the quality of data drove everything we did, because our financial technology was dependent on having quality data fed in so we could have quality data fed out to the advisors. And so when the opportunity came up at LSEG to join the data side and content side, I came over here as an interesting opportunity, one, to come to the vendor side and really understand the client needs, but two, to start to intimately understand data, the power of data, the quality of data, and how that could transform our industries.
That leads me just into my next question, because if I'm understanding it correctly, in terms of value proposition and fee structures generally stayed the same around a sort of 1% number for sake of argument, but the value proposition of wealth management has changed. It's been able to become more personable. Do you want to just talk a bit about how it's changed over the years?
Yeah, the value proposition in wealth started with just running an investment portfolio and trying to have that portfolio, for all intents and purposes, beat the S&P 500. If you look about 25 years ago, that was still the focus. We've seen this evolution from what I'll call investment planning to life planning, because life planning includes everything from, do you need a car? Do you need a home? What other expenditures do you have?
Have children?
Do you have children? College? But also, do you need insurance?
Right.
What does your overall wealth portfolio look like? And then how do you structure investments around that? What the industry still needs to look to do, though, is fully bring all of that data together in a more scalable way for advisors. Because once advisors have all of that information, they can truly look at that holistic portfolio and lead investors to the right place. I think the other key trend we've seen, which is a huge shift in this industry, is that during the pandemic, we started seeing advised investors who have an advisor their whole career move a portion of their portfolio, not all, to self-directed. And there's this balance now between wanting to do a little bit on your own and have your advisor oversee most of it. Very similar to a talk we saw today, where you've got some money that you're willing to lose, that you really want to see what you can do with in the stock market, and the rest in a different portfolio. Well, most firms haven't figured out how to see those as complementary rather than competing. So when we look at the wealth management space in particular, we're going to see an evolution of seeing this complementary nature of investment pools, all the way from self-directed into advised, and then to fully outsourced for those who aren't interested at all.
Now, I think 2022 will go down as a volatile year for many markets, all the way from crypto to stocks to bonds to real estate, really. Do you think that plays the trend you were just talking about people wanting to do it themselves? Are you expecting to see a reversal back towards managed wealth money?
I expect for the smaller accounts that we won't see that reversal back, because let's say you have $100 and you lose $100. That may or may not hurt. And most likely if you've invested $100, it's because you want to try to make it big and you're okay losing it. If, however, you've invested 10, 20, 30,000 and that's a good chunk of what you have, the market volatility will lead people to calling advisors, because all of a sudden it's much harder in a market that's not constantly going up to truly make money. But more importantly, if you're in the tech industry, for example, and you see your portfolio drop 20, 30%, you have to start to wonder, is it really the amount I want to risk? Now, will 100% of those assets go to advised? I don't believe they will. I actually still believe there will be a portion of the portfolio that remains self-directed, and then a portion that the investor wants to be safer with an advice component of that portfolio. And that's where, again, those have to be complementary in nature rather than seen as competing solutions for the market.
Going back to your point on personalization and data, do you feel that you have gone as far as you can in terms of using data to be able to give the most personalized experience, or is there still further to go?
I have a viewpoint that's a bit different than most in the industry. I believe that given all the regulation, given data privacy, that companies are doing the best they can to bring the data together as quickly as possible. If you think about most of our customers, whether they're large banks, broker-dealers, the legacy organizations who have been providing stable services for years, decades, they have disparate systems with all that information, and bringing it together isn't as easy as putting food together on a plate so you have a full meal. You really have to go to the grocery store, actually find where that fruit is, vegetables are, where the meat is, bring it all back together and make the meal. That takes time and effort. Where I think we have a ways to go as an industry is the data that people are willing to give themselves. So I think about my daughters. We get in this debate because they buy shampoo that's supposedly personalized, and they answer 10 questions about the shampoo, but it drives me crazy because they pay twice as much for it, and I guarantee you there's only 10 flavors of shampoo. Probably less, probably 5. But they answer only 10 questions. Is your hair curly? Is it straight? Is it fine? Is it not? They view that as personalized. So actually, if we think about the next gen view of personalization, of those coming up and then through into the wealth market, it's not just about what assets do you have. It's about what are the most important questions to them that they're willing to answer that then can help you build their financial plan.
And do you also feel there are questions like, you know, there are difficult questions to ask yourself about mortality, about morbidity, about wealth transfer. Do you feel that there are clients out there who still don't ask themselves those kind of well, I say simple, they're not simple, they're difficult, but they're necessary?
Yes, especially the younger you are. And I don't generally break things into age categories, but if we talk to the 20-year-olds, very few of them are thinking about life expectancy because they're in their 20s. As you fast forward, though, to those getting nearer to retirement, they're thinking a lot more about it. But at that point, it's too late, really, to be thinking about what mortality is. So it's interesting because growing up, I've had a lot of longevity of women in my family. So my great-great-aunt lived till 103. Great-grandmother's both 98. My grandmother's 95 now, lives on her own, fully independent, just got her driver's license renewed. I've been thinking about longevity since I was in my early 20s. And my friends used to make fun of me. But I kept saying, look, even if I want to retire at 70, I've got a lot of years to make my assets last. I have to start saving now.
Right.
It's hard to answer those questions. And I think we as an industry need to start to figure out how we reframe those questions too, so people are willing to answer them, or even create a model or a system where they can input data and we can give them nudges as to what their longevity might be. Because if you think about actuarial calculations, they're really complex. Most normal people don't know how to do them. It'd be like telling me, I want you to go assess right now whether your car's engine is in perfect condition, how long it'll last, how long will you drive the car, when will you need a new one. I'm not an engineer, and I'm not a mechanic, and I'm not going to know the answers to either of those because I don't know how to read the computers, and I can only change the oil in my tires. But we expect people to do that in the investment industry. That's crazy.
Yeah.
It's crazy.
It's such a big deal in people's lives, and people completely underestimate how important it is.
Yeah, so the more education we can give them, and the more access to experts. By education, I mean simply being able to ask a question or give them a nudge as to what they should be thinking about, or simple ways to calculate it on their own with minor inputs. That would be good. I mean, when the check engine light comes on, I know something's wrong with the engine. We just need a check engine light that's much more intuitive than we have today.
It's funny what people spend their money on. They'll spend thousands of dollars on holidays or cars, but when it comes to your own personal wealth, it's like, what's the cheapest I can get that for? And I guess what you're saying is there needs to be a sort of mental shift, and people realize that you need to pay for this stuff because it matters.
It matters a lot.
So another question I had for you is, what is the change in demographic for the kind of clientele who are falling under the wealth management umbrella? I'm probably simplifying it, but I'm guessing a lot of it was middle-aged men sort of years ago. I mean, are you seeing more women, more minorities?
Let me break it down. If we look at those who are heading into or already into retirement, at this point, let's call them baby boomers, it's still male-dominated. That will change in the next 10 years because what we know for a fact is the actuarial tables, life expectancy is longer for women. So those assets will likely move to spouses first. So you're going to see an increase of women who've never been engaged by their advisors. And the financial industry needs to solve for that, not yesterday, but 5 years ago, and they haven't yet.
Interesting.
If you look then at Gen X, I actually call it the missing generation. How often do we hear Gen X talked about in any of these discussions? We jump from baby boomer to millennial, but Gen X have more women working than any other generation, have dual incomes. What you're going to see here is almost this 50-50 split of male-female in terms of wealth. And how advisors engage with couples and or individuals in Gen X will be critical, because the baby boomer generation is passing to both Gen X and millennials, not just millennials.
Yeah.
Where we really have a gap, though, is still diversity. Because if I look at, let's say, people of color, if we start thinking about what access they have to banks, many of them, or trust they have in banks, it's lower, and surveys show us that. But more importantly, they've got no financial advisor that looks like them. It's hard to find a financial advisor that looks like me, let alone someone of color, and we have to change that in the industry.
Yeah.
In the industry, we have less than 2% of the financial industry represented by people of color. That is a terrible statistic. And it's, by the way, it's only 10% for the younger generation.
Yeah.
So we really need to start recruiting and bringing in people who look like them so there's more trust. There's this other group in terms of first generation Americans, for example, that aren't investing anywhere. They're not investing with the banks. They're not investing with advisors. And no one's focused on how do we really reach those individuals? How do we reach those individuals, again, with people who understand their circumstances, who are also first generation, who can meet them where they're at? That, though, is going to require decades of refocusing on investing in the young generation. So think high school, college age, and really breaking apart all the myths about what it means to be in the financial industry, what it means to be a financial advisor, and shifting it. I also believe compensation models have to shift.
Right.
Here's why. One, men tend to be riskier than women across all stages of life. That means more men are willing to take the risk of a commission-only based salary scheme at the beginning of the career. Less women are. As you get mid-career, it goes down. But then if you think about commission-based only schemes for women who end up having children and have leave, how do you keep that commission going? So there's a lot of gaps. And it's the same with minorities, people of color, first generation. Do they really want to take that risk? So thinking about new models, and we've seen some of this actually globally, where you have the younger generation of advisor who works with an advisor who has a portfolio already built. They're working with folks of their own generation. So think lower account balance, but getting paid a salary. As they transition to take the book of the next gen, they're moving up then in income, and then it's slowly replaced by a commission scheme. So as we think about the wealth industry, we really have to start thinking about how are we going to compensate to bring in more diverse talent so that they can provide advice to people who look like them.
Yeah. No, very interesting point. I'm going to ask you to look into a crystal ball into the future now, if you don't mind. As you look out into 2023, what's one prediction you have for the wealth management industry?
For 2023, the one prediction I have is that we'll see a slowdown of trades in the retail space. It doesn't necessarily mean the number of retail investors. I think we will see a slowdown in trades, and we'll see more companies refocusing on that data piece of it. How do they get the right data to their advisors to actually generate better advice and grow their practice? I also believe in 23 we'll start to see a focus of organizations in terms of what they actually want to achieve, which is why I said the focus on data. Because in the current economic environment, operating environment, capital is limited, the markets aren't going up. So where firms spend their capital is going to be really important. And most firms have recognized they sit on a gold mine of data. And even if they can get just 2 or 3 key components of that data into the right place for their advisors, it automatically creates scale. So I truly believe 2023 will be the year where we really focus on what are those small steps we can take to drive that personalization forward in the industry and equip advisors to really connect with their customers where they're at.
Makes sense to me. Sabrina, it's been such a pleasure chatting with you today, and thank you so much.
You're welcome. Thank you.